Hello traders, Gary Wagner here at just after 1 o'clock in Honolulu, 6 o'clock in New York. It is Tuesday, 17th day of November 2020, and this is the daily report for gold and silver. We have identified a chart pattern simply called a death cross, and we will focus upon that particular pattern and its implications during today's show. But first, to the price board. As you know, over the last few days, we have been talking about the fact that we saw the shorter-term 50-day moving average moving closer and closer to the 100-day moving average. It appeared as though we might see a death cross, or the point in time in which the shorter-term moving average crosses back below the longer term. That is precisely what occurred today. We'll talk about that in detail, of course, when we pull up a chart. But we do have gold down substantially, about $8.60, currently at $18.7920. That's a net decline of approximately 0.5%. When we look at spot gold, that is also trading under pressure, and it is also now below the December contract. We talked about the inversion that we saw where spot was $1 or so higher than December futures. That is kind of reversed now. Currently, spot gold is at $18.7830, and that puts it down about 94 cents on the day. Silver dropped about a full percentage point, or a total of 24 cents, currently trading at $24.56. And dollar weakness today, that actually meant had we not had dollar weakness today, the decline in gold would have been much more severe. The focus of today's opening letter, along with the charts that we are about to look at, honed in on the fact that we identified a death cross today between the 50 and 100-day moving average. There were really three components or times that we were looking at. The first point that we identified I've just circled, and that comes towards the end of January, when we saw the shorter-term 50-day, which is in green, move above the 100-day, which is in magenta. Of course, this was the beginning of the pandemic, and as gold traded through February and March, it did hit some lows in March at around 1450. That's this area here. And then we had a long period of time, really months, in which we saw the 50-day trading above the 100-day moving average. And in terms of the distance between the two, it was pretty much stabilized at approximately $60. We can see that as the market continued to rise, the differential between the 50-day and the 100-day were about $60 apart. That changed really as we went into the middle of August and September, when we began to see that the spread between the two prices started to widen. They actually hit an apex in terms of the widening up until the end of September, beginning of October, and that is a point in time in which we saw the widest differential between these two moving averages of approximately $100. Because the shorter term is going to be more sensitive to short-term price fluctuations, you can see how this really moved into the 100-day moving average, and today we actually got our cross with the 100-day moving average, at least for now, above the 50-day moving average. The net result is that we could identify a chart pattern simply called a death cross, in which the shorter term moving average moves below the longer term. And we did get that today. That could signal lower pricing as a technical indicator. We have to acknowledge that by inherent definition, a moving average must be a lagging indicator, which means that a moving average inherently will always show a reflection of changes of events or news after they have already occurred. Obviously, the shorter term the moving average is, the quicker it will react to fundamental changes or new events that are causing price changes. However, on a technical basis, when traders see this type of a cross, it will signal them to sell into the market, anticipating lower pricing. In that way, A death cross can actually be a self-fulfilling prophecy in that technical traders will use this chart pattern to initiate short positions in the market. The other thing that you need to be cautious about when we look at this type of chart pattern is that there are many points in time, and you can see that as we compress this chart, when you get these crosses coming in for a very, very short time period, such as right in here. This occurred, of course, in December and November of 2019, and you can see the time span in which we first got the shorter term 50-day moving average crossing below and then crossing back above was a period of time of about 2 months, which reminds me of a story that was told to me by Larry Williams about the limitations of technical analysis. His description of a technical analyst is one who is sitting on a boat at the back end of the boat looking at and trying to determine where the boat is headed. However, only the captain knows when he will turn the wheel. The point behind the story is that it is fundamental events that move the market. Technicals are a way for us to distill information out of price movement, but changes in fundamental events will always occur before we see changes in the technical indicator. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.